Hello, everybody, and welcome back to the Off-Farm Income Podcast. Thank you very much for joining us here on our YouTube channel for episode number 904. Well, today is kind of a special episode. I do these every now and then. I was contacted by Brandon Bruckman. He is an advisor for Insight Real Estate Partners, and he and his partner are trying to reach farmers to talk about the option of doing a 1031 exchange when they retire and sell their farm to help them offset or avoid taxes and create passive income. Now, I want to talk to you about when I do these episodes. When I do these episodes, I do not get paid to do these, and as a matter of fact, I have never been paid to do an episode and to highlight or profile a business. I do it after, when somebody reaches out to me like this, I investigate and I look into the process, into the product, and I ask myself, is this something that I think could help farmers to succeed in life, to move on to the next phase, to be successful? And if it is, I'm willing to profile it as long as we're providing good information to farmers and not just a commercial for the business. I don't take any money to do this, and I don't take any money to do it on purpose because I don't want it to be clouded. I don't want it to appear as though I am promoting or advocating for something because somebody gave me money. Now, what Brandon's going to be talking about today is using 1031 exchanges to help farmers who want to retire but want to avoid the tax consequences of selling their farm outright. I'm not advocating for this. I'm not promoting it. I'm not saying this is something that you should do, but I do want to be the conduit to provide you this information in case it helps you achieve the goals that you have as a retiring farmer, or maybe helps an aging relative that you have achieve the goals that they're looking for as a retiring farmer. So that's what today's episode is all about, and we're going to get into it for you right now. Brandon, welcome to the show. Thanks for coming on today.
Matt, thanks for having me. Really appreciate it.
You bet. Hey, thank you very much for reaching out, by the way. I appreciate that, and doing this podcast has really provided me with a platform to talk about a bunch of different topics that can help farmers. And anytime somebody reaches out, even with a business like what you have there at Insight Real Estate Partners, if it looks like something that can be of a legitimate benefit to a farmer in whatever capacity or whatever stage of the game they're in, I like to highlight it. So thanks for taking the initiative, because it means a lot to me.
Absolutely. And sort of same way as we think about getting this word out to farmers, and we think about the farmer clients that we've worked with, the amount of education that's going to be needed in this space to provide value is really, really high. So anything that we can do to put that word out for farmers that they have options like this is absolutely awesome.
Well, it's definitely something that I don't know what the business jargon is for it, but we all know the average age of farmers in the United States. So this is going to be, I would think, an ever-increasing need, and somebody's going to have to provide that service to farmers.
Yeah, absolutely. And we watch an aging population about our business and thinking about retirement and transition, and our oldest baby boomers are turning 75, and that's sort of I think experts call that a demographic tsunami that's sort of coming our way of older folks presents all sorts of opportunities for us to think about how we add value.
Mm-hmm. Okay. Well, let's do this. Let's start off with you. Tell us about you.
Wow. Okay. Where should I start? So currently I'll kind of go backwards, forwards. So right now, as you mentioned, our firm is Insight Real Estate Partners, and I'm spending a lot of my time helping farmers, real estate investors, or folks that are selling a business that have real estate inside of it. I'm helping them think about, how do we defer tax, and then how do we earn passive income from the proceeds of those sales, right? So we're thinking about, and I'm sure some of your listeners know or have heard of 1031 exchange.
Mm-hmm.
So we're thinking about executing that, and I can talk about that today if you'd like. But we're thinking about executing that, and I think the common misconception here, especially for farmers, is I got to go buy another farm. So they sit there and go, well, I don't want to do that. I'm approaching the age where I want to pass this on to heirs or retire. I'm not interested in doing that, so I'll just wait. And we actually hear this a lot in the real estate space as well, is they use the term swap till you drop. And it's a little morbid to think about, but what they're really saying is, I'm going to continue to exchange properties until I die.
Mm-hmm.
and I get a stepped up basis. So that's a viable thing to do. But we think there's other options as well, and we can talk about those. So myself and my partner works out of Kansas City. A lot of farms around that area, obviously,
Mm-hmm.
in Kansas is where he spent most of his time. I live in and born and raised in Milwaukee, Wisconsin. Probably many farmers up north will call us city slickers down here, unfortunately, but we got a lot of farms here too, and we're all Wisconsin as well. My wife's born and raised. If your folks are familiar with Wisconsin, in an area south of Door County, so all you see when you get in outside that Green Bay area is farms and farmland. So I've learned a lot from her about some of the struggles that our farmers are facing. So that's where I'm at now. Prior to this, I've done a lot in the investment space. So pretty far away from real estate. I spent quite a few years at a pretty big hedge fund. I've helped start a couple different consultancy companies, but when my partner in Kansas City, his name is Josh Wright, presented me with this opportunity, it was really compelling for me to think about, a group of people that just don't know about this service,
Mm-hmm.
and that we could help pretty dramatically.
Okay. So farmers, when you're going to be, dealing with this level of their wealth, they're going to want to know what your connection to agriculture is. So is that connection because you see an opportunity here, or is that something you grew up with? Is it your partner? Is it your wife? I mean, where does that connection come from?
There's a good connection here with my partner and my wife. Frankly, it's not me, and I want to be really like upfront with that I don't come from this background. So I need help from our team here. I need help from the team that's around you in this transaction. So I can't be the only person here for this transaction. So your accountant is critical in helping us think about not only the land, but the property or the equipment associated with this transaction as well, and what this means for you holistically. If you're thinking about retiring, that is critical. So we need a team around this transaction. So we're leaning on some pretty good partners there that have a deep history in the agriculture space and understand how to deal with these transactions and think about it holistically.
Mm-hmm.
The part that I'm really focused on is thinking about that land and how we can 1031 exchange that land and get you more income passively through different real estate type investments. That's
Okay.
where I'm focused on, right? So I'm spending a lot of time thinking about what does that mean for you? What sort of cash flow do you need from those investments? And I spend a ton of time doing the due diligence and thinking about these investments are good investments or not. Unfortunately, what we have a little bit, Matt, in this space is investments that are designed to meet the criteria to help farmers defer tax, not good investments on a standalone basis. And that's really what we want to narrow in on is I want to make sure that this is a good investment for you, period. Deferring the tax is a huge benefit to
Mm-hmm.
doing the transaction, but we need to make sure we're making a good investment. So that's what I'll spend my time being focused on.
Okay. Well, you've mentioned the 1031 exchange a couple times. Why don't you go ahead and explain to us what that is and how it works?
Yep, absolutely. So think about the 1031 exchange in this way. The IRS it's a portion of the IRS tax code, and it's helping us sort of think about swapping one property for another. What the IRS has done for us is said, hey, you have to exchange properties that are, in essence, like kind is the terminology that they use. That's a very broad definition, not narrow. So when we talk to our farm clients, most of our farm clients think I have to exchange a farm for a farm. It's not the case.
Mm-hmm.
We can exchange a farm for any sort of investment real estate that you would like, right? So that opens up a variety of opportunities for us to think about taking maybe one piece of farmland, and turning that into potentially a diversified portfolio of different real estate properties. So the 1031 exchange allows us to defer not only the capital gains tax we have on our sale, but also the depreciation recapture as well. So when we look at the tax bill that most of our clients are looking at paying, it's very substantial. So the average tax bill that hits our desk is between probably 400K and up that we'd be looking at and paying taxes if you sold outright
Mm-hmm.
and paid those taxes. And a good chunk of that is coming from depreciation recapture. So there's that piece, as well as any local or state taxes that you have involved as well, are typically deferred depending on what state you're in. So there's a huge bill here that obviously you don't want to pay and you want to defer. So the 1031 exchange allows us to do that. There's some very cursory rules that I'll talk about on top. that we have to be aware of. Planning is critical for this. So here's where people go wrong. They will show up on my desk and say, hey, I just sold this property. What can I do now?
Mm-hmm.
It's like, well, you should have planned this before you sold the property about what we're going to do in the exchange, because it's critical that you have someone standing between you and those proceeds that you're taking. It's referred to as a qualified intermediary. They need to step in and take receipt of these funds before you do. If you're holding a check from the sale of your property or sale of your farm, you're in trouble, because there's not much that I can do at that point. You're probably going to have to pay tax. So planning is critical here. You have to have a qualified intermediary involved in this transaction. And you really want to think about, how am I going to plan this out? Because the timeline around 1031 exchange is very tight. There's only 180 days from the day that I closed on the sale of my farm to the day I need to purchase something. It's only 180 days. And it sounds like it's a long time. I can tell you that it's not, in watching these transactions happen in real time. So it moves very quickly. There's another timeline in between there, the 45-day mark. That's the identification period. So from day 0 to day 45, there's 3 rules that you can follow to identify something that you would like to buy. So it's very critical. Again, as you can see, our world is shrinking second by second here in the timeline, right? Like, we really got to be in front of this and planning out what we're going to do next before we get into this. Our best clients come to us months before their intent to sell, and we'll say, hey, what can we do? And then we will close and make that allocation literally the next day. So we don't need to worry about timelines and the rules to identify and all these things that people fret and worry about. We don't need to worry about, because we plan that up front. So it's really critical to do that in the 1031 exchange.
Okay, so if I'm understanding what you're saying correctly, when somebody is ready to sell their farm, in order to avoid these tax bills and paying these taxes, what they need to do is they need to get with you or a company that does what you do as the intermediary, and then they've got to identify the investment property they're going into before they sell their farm. And then I would assume you or a company like you, what you're going to do is you're going to coordinate everything. So when they have a buyer for the farm and they've got the place they're going to invest in, those transactions are both going to close within a couple days of each other, so you avoid any concern about this 180-day time period. Am I understanding that correct?
100%. What we see is, we don't see someone like us standing here helping farmers coordinate, or any real estate investor really. We don't see them here helping coordinate this transaction. Because it's critical before we even start the 1031 exchange is to understand, hey, should I even do a 1031 exchange? Like, what do I actually owe? Right? So it could be a situation where, and we want to take you through that planning step to say, hey, do I need some of this money coming off the sale? You might. Mm-hmm. Right? You may not want to exchange all of it. You might want to do a partial exchange. Completely viable thing to do. But you want to have the planning. So yes, absolutely, starting with someone like us to help coordinate between yourself, your accountant, your lawyer, if they want to play in this, would be valuable as well. And then to have a qualified intermediary to coordinate that transaction is something that we definitely do and can help with. It's critical stuff.
Okay, so sometimes, at least where I live, I'm watching, like, we're in a red hot real estate market where I live. I live near Boise, Idaho. And our real estate market for residential is just unreal. But then I watch acreage, and I watch acreage sit there and sit there and sit there. Matter of fact, there's 77 acres next to me that just sold, but it's been on the market for about a year. So it moves at a different pace than what we're seeing with residential. So how do you coordinate all this so that if it takes a while to get a buyer and to get this piece of ag land sold, there is the investment property that they want to purchase that's available and ready to be closed when that moment happens? How do you, I mean, you might identify a piece of investment real estate you want to buy, but if it takes you a year to sell your piece of property, then maybe that's gone by the time you get there, I guess is what I'm getting at.
Yeah, no, that's a great point. And so I'll address that. The key, what's nice for our world, the investment on the backside, is there are a variety of these investments that are available periodically in this space. So I was just having this conversation with my partner this morning. There's no shortage of supply on the back end for us to invest in. Okay. That's usually never an issue. As we went through this COVID situation and continue to go through this COVID situation, when this first hit, a lot of supply did dry up, and this was a little bit of an issue then. We've gotten past that. So there's There's abundant supply in the marketplace of good deals that when you're ready, when you're able to execute that sell transaction, what you want to buy or similar things that we could buy are there for you. There's a very active market here in passive investments that's available and somewhat similar, I will say, in types of deals. So if you're interested in, property A as that next investment and it's gone, those things do happen. Property B is staying there too, and it has similar characteristics to A, right? So there's a good steady supply of that happening on the backside. But it does present timing is important here. So I mean, if we're a little early to that transaction, if we're talking 6 months in advance, things that I would show farmers from an investing perspective are probably going to be full.
Okay.
But if we're 2 months in advance, more likely than not, we're going to have those investments available or something very similar.
Okay. Well, give us some examples of the type of investments for passive income that we're talking about.
Yep. And so we're talking about it, and this is where it gets a little tricky. So I'll slowly take folks through this. Is the first option that we're talking about is through a vehicle called a Delaware Statutory Trust, or DST. And that sounds scary. But what it is, in essence, is you're owning fractional real estate of a much larger property. So, for example, say $100 million Class A apartment complex. You're owning a portion of that through your investment. And it's done through this vehicle, so we can do a 1031 exchange. Mm-hmm. So that'd be most of the properties we see are that sort of multifamily, real stable Class A type property. It's about 60-65% of the space. The rest of it's a variety of things, from medical offices to self-storage facilities. We really like the self-storage space, very economic resistant space. There's senior living in this space, industrial. A lot of what's referred to as triple net lease type properties. Think about your like Dollar Generals or Walgreens, for example. You can imagine the durability those are having in this economic climate. So what's fun is the minimum investments here for these are about $100K or so. Mm-hmm. So you can see what happens with Matt. You mentioned that piece of land down the street. You can start to see what you can do from a diversification perspective. You can buy 3 or 4 of these investments in the back end, and all of a sudden you're across multiple different industries. What's most intriguing for us is sort of the cash flow we see come off of these. So cash flows range from about 4% annually to we've seen up to 8% in this space of cash flow, bottom line to investors on your invested capital. As we've started to dig through P&Ls from farms, we look at the economic comparison there and we're like, man, the opportunity to go to your mailbox and pick up a check with let's say a 6% return on it, mm-hmm. sounds pretty intriguing. Sounds pretty interesting from that basis. So that's typically what we see in the space is those kind of verticals and that kind of cash flow.
Okay. So it's not like the farmers buying 5 rental houses or something like that and then having to manage them. It's a fraction of a larger investment.
Absolutely. Yeah, let's talk about that. So it's completely passive. So there's no decision rights for you to make on buying, selling, managing, kicking out tenants. None of the typical things you would expect from being a landlord of one of these properties are mm-hmm. your responsibility at all. So it's important for us they're called sponsors, the people who put these products together. It's important for us to work with the investor so that you understand the sponsor, their history, and how they operate. Absolutely critical. Almost more important than thinking about the actual deal is how these firms actually do business. Mm-hmm. So it's critical for us to do that research up front, but there is no management to do here whatsoever. So very appealing to the vast majority of our clients are over the age of 65. And I say, you know what, I just don't want to, I've done the work. Yeah. I'm good. I've done it. Right. I'm ready to, enjoy the fruits of that labor. Okay. And so this is a great option to do that.
Okay. So there's no management, but what about liability?
None of that's coming back your way either. So what's great about this, even on the debt. So some of these properties do use debt and leverage or take a mortgage out to buy that property. That is non-recourse to the investor. So all that recourse is to the sponsor and to the trust company, and is completely away from the investor. So no concerns there either.
Okay, and then help us understand and gauge the level of risk in this type of investment versus going into mutual funds or something like that.
Yeah. So a couple different ways to sort of think about that. So this is a real estate investment. And we have to look at the real estate investment the same way we would any other real estate investment. So it has risk. So there's always risk associated with multifamily, for example. I mean, what's a huge risk right now? Obviously, the situation with COVID, our inability to kick people out is a big problem across the country, and in some cases. So for there, we're looking at how do we minimize that? Want to make sure apartments complexes are affordable for the people who are living in it, and they're paying, right? So it's critical for us to understand that operational component now. But there's risk associated with that. There's risk associated with the triple net lease properties as well. What if those facilities aren't performing as well? Or if they want to close, Walgreens wants to close a location, they may do that. So understanding like location level profit and loss is critical. When I compare this to sort of think about, I'll kind of take a page from some of our investors. When they look at this versus say a mutual fund or putting money in the stock market, real estate investors, or let's call them classical real estate investors, would look at the risk begot by investing in the market as much, much higher than investing in real estate. They would carry that torch with them for forever. To talk about how much less risky it is to invest in real estate compared with investing in the market. And we would tend to agree. The downside of investing in the market is very high. And that's not a commentary on what may happen in the future. It's just fact, right? We've seen 30 to 50% losses in the market. Periodically, it happens. We don't really see that in real estate. So when we look at the sponsor history of a lot of these DSTs, we don't see those kind of losses. We rarely see programs that don't work or don't provide a return to the investor. So we just think of these as much more solid and stable investments than, say, mutual funds.
Okay. And is there a guaranteed rate of return? Like, is there a minimum?
Never guarantees, but the P&L is structured in a way that the sponsor is committed to delivering that number. So I'll give you an example. So one sponsor had recently purchased a property in Las Vegas, of all places. So you can imagine how that has done as we've gone through. They purchased that pre-COVID. Unfortunately, you can imagine what that looks like when we went through COVID.
Yeah.
So this sponsor in particular, and again, no guarantees, this sponsor cut their management fee to make sure that they're still returning the numbers that investors expected them to return. So these are designed specifically and conservatively so that when they say that you're going to get 5.5 or 6%, you get 5.5 and 6%, regardless of what's happening in those sort of monthly fluctuations with the investment. The sponsor's committed to delivering that because they understand. I mean, we talk to clients that say, hey, I need this level of cash flow to live. I live off the cash flow from these properties. That's my job, right? And so having that sort of, again, not a guarantee, but that sort of discipline, let's say, from the sponsor to deliver that return consistently is exactly the way these products are structured.
Okay. How do you, at Insight Real Estate Partners, how do you make money from these transactions?
Yeah, it would be nice if we just worked for free, right? There's some cost there. So we will get paid. We're here to consult. So we'll sign a consulting agreement with our clients. And we'll take a fee out of the qualified intermediary for that transaction. What's nice in most of the Delaware statutory trust deals is there's a commission, a sales commission that's built into that deal that we actually can't receive as investment advisors. We can't get that money. So it actually goes back to our clients. So it's a weird thing to sort of think about. So we're taking a fee, but then the sponsor is giving you a fee they would have given to one of our competitors, goes right back to our clients. So in essence, that really balances out, what we're taking from the transaction is really brought back to you by the sponsors.
Okay, so I'm thinking of this fee in terms of like when you sell a property through a real estate agent, you pay 6%, and it goes to the buyer and the seller's agent and all of that. That's what I'm thinking of. Am I thinking of this correctly, or are we talking different fees here?
Nope, you're thinking about this exactly. It works in exact the same way.
Okay. So basically because you're not allowed to take that commission based on, I'm assuming, statutes, that you're charging a fee, but then you're representing the buyer, and so what they would normally pay in commission, you're refunding that back to them. Is that what I'm understanding?
Exactly. So my representation is with the investor and the client and the farmer, period. Right. And so my agreement is with them, and I have a fiduciary responsibility to them and all that really good stuff that we talk about, where I have to do what's in your best interest. So I can't get paid from the sponsor. So you're exactly right. That commission, like, where does it go? Fortunately for the investor, it goes to them.
Okay.
It's a very, very good thing. They're starting to head in these deals where, frankly, other investors that are in the deal aren't. It's pretty weird how it works. I had to see it work the first time myself. And I was like, wow, that's a really big benefit to get 6% or so back on a transaction. To start with. It's a good place to start from.
Okay, so we'll take a hypothetical. Let's say that somebody has farmed their whole life, they're ready to retire, and they don't have anybody they want to pass the farm on to. They want to go and they want to have this passive income and they want to shield themselves from taxes. So they've got $500,000 to invest. I'm just giving you a hypothetical. They invest the $500,000, and while the money is invested here, conservatively, they're going to get 5 to 6% back. And so they're looking at an annual rate of return of around 6%. Am I understanding that part correct with my hypothetical?
Absolutely.
Okay.
Yep, you got it.
And when they either pass away or when they decide they no longer want to be involved in this investment, what happens at that point? Do they get they sell the investment? Do they get the same amount of principal they invested back, or is that principal, is it like having a share? Has it gone up in value? How does that work?
Yeah, let me take it apart a little bit. So let's say, unfortunately, let's start with maybe they pass away.
Okay.
So if they do unfortunately pass away, this investment is treated the same way the farm would be treated. Your basis is going to step up, and you'll be able to pass that to the heirs. So be able to actually pass that investment to your heirs, they'll start earning that cash.
Okay.
Exact same treatment. Same treatment on your taxes too. If you would own an investment property outright, treated the exact same way on your taxes as well. So in the eyes of the IRS, it looks like you own that property outright, which is a great thing because you're still able to take advantage of depreciation, mortgage interest deductions, all that fun stuff that real estate investors are able to take advantage of. You are too in investing in this property. So that's part one. Here's the bad news. If you do want to sell and get out of this investment, there is not liquidity. So you can't sell this like a mutual fund tomorrow on the market. It doesn't work that way.
Okay.
So the sponsor is going to dictate when they're going to sell that investment. And that's usually a 5 to 7, maybe even a 10-year time period in which you're going to be in that investment. So it's very critical. Remember what we talked about before, planning before you come to this table, right? It's critical to think about. If you're like, Brandon, I'm going to need that money in a couple months or a couple years, this is not the right place for you to be, right? You need to think about a different plan to make sure you have the liquidity that you need. So you're locked in here until the sponsor sells. When the sponsor sells, you're getting return of capital from that sale. You're also getting any of the upside appreciation associated with selling that property, right?
Okay.
So not only are you getting the maybe 5 to 6% annual cash, you're also taking advantage or getting a portion of that upside as well when you sell. So there is upside appreciation there on the backside associated with the investment as well.
Okay, so there's appreciation, and when you go into this, you're going to know up front that in 5 years or in 7 years or something like that, this is going to be sold. I'm going to have to do another exchange.
Correct. So a good sponsor will lay out for you what their business plan is. Say, hey, we want to hold this thing for 7 years, and we understand who the buyers, frankly, are going to be at that 7-year mark. We usually sell to, here's a hypothetical, we usually sell to these sort of big REITs, love to buy this property at this point in this cycle, right? Those are the kind of things that I want to hear from the sponsor. They have a really solid exit plan. Having a solid exit plan here is critical. Now, there's nothing stopping or preventing that sponsor from selling that early, and we want them to do that, frankly. If they find a good deal in year 4, that's phenomenal. I'll take it. Let's do that. That makes a lot of sense. Okay. Right? So we want to give them the latitude to work that property and do what they do, and that's make good real estate transactions.
Okay. So let's say it's 2001. You invest. The sponsor says we're going to sell in 7 years. 2008 hits. The bottom has fallen out of the real estate market. Are they committed to selling at that point, or can they change plans?
They can change plans. So that's exactly what we want them to do, is to think about year 7, day 1 of year 7 may not be the right time to sell, right? And so we want them to kind of keep thinking about that and delay that sale and to maybe come up with a different plan to move that property. So yeah, nothing is set in stone about when they sell. We want them to have a good plan, but we also want them to be opportunistic.
Okay. Is this considered a REIT?
It's not. And that's a big common misconception too, is when I think about REITs, I start to use words like blind pools. That makes me nervous. It makes a lot of traditional real estate investors very nervous. Like, well, what the heck do I own? Like, I don't even know, right? This is not that. I know exactly what I own. I know exactly I'm going to own this the entire time. It's very, let's say, structured in a way in which this isn't going to change. We are going to own this piece of property for a period of time, and that's what it is. We know what it is. We know where it is. We can walk up to it and touch it. In that way, it is. There's a lot of differences from a REIT, where I've owned REITs personally. I have no idea what's in there.
Mm-hmm.
That makes a lot of people nervous. So this is different than that.
Okay. Okay, so I want to touch again on the benefits to the farmers who choose this option. So here's how I'm understanding it, Brandon, and you tell me if I'm getting it right. So when the farmer goes to sell the farm, they're going to pay the capital gains on the farm, and whatever they've taken out in depreciation, they're going to have to compensate for that. And so that's going to be a certain dollar amount. If they do this, they can avoid all of that because they're doing the 1031 exchange, and they can just keep rolling these without having to actively farm, actively work in the investment, but have the same tax benefits and tax shelters until the day they die if they keep it going that long. And then once they do pass away, if they pass this investment on to an heir, then the basis for which that heir will have to pay taxes, or the estate will have to pay taxes on this, is determined by the value when it's passed on, not when it was purchased. Is that right?
Absolutely. Absolutely. Everything you said is accurate. Well done.
Well, yeah.
You got it, man. There's a lot here, and you digested that perfectly. Well done.
About 1 out of 100 times I'll throw a dart, it'll hit the bullseye. So there you go. Okay. So I see the benefit to it, and this is a way for. So I guess if a farmer out there right now is they're looking at retiring, they don't have somebody going to pass the farm to, and they're looking at this as an option, how should they go about doing the math to determine whether or not this is the right decision for them? So do they need to get with their tax advisor and determine what their tax bill is going to be when they sell the farm, and then compare that to the return on an investment here plus the savings of taxes? I mean, how would you advise somebody to determine whether or not this is right for them?
That's exactly the way I would start to evaluate it. I would get with my accountant, figure out what my tax bill is, but then I want to think one more step from that, and I want to kind of separate it from investment. Everyone that we talk to starts with economics, and it immediately goes into what this means for them and how it's personal. So, and what do I mean by that? So it more becomes a question of how do I want to live my life and what I want to do. That's the question that ultimately they're going to need to answer after they understand the economics, right? So I might have a tax bill of $400K. Do I need some of that do I need some of that cash from the sale of my property, the sale of my farm, to go and do something that I really want to do? That's possible. Mm-hmm. I hear that a lot, right? I need this liquidity because I want to give a gift to my son. I need this liquidity because I want to take a vacation. Right? And so it becomes a broader conversation than just economics, but that's the start point. You really want to understand, where am I? What is the tax that I'm going to owe if I decide to execute this? And then what can I defer? Where do I need money? Do I have enough liquid assets to execute this transaction? The answer to those questions, I think you're in a pretty good place.
Okay, so as I'm thinking about this, I'm thinking about having this capital in the bank versus in this investment. Once you've invested, let's say you got a 7-year time period, it's locked in there for 7 years, is a hypothetical. Now let's talk about long-term care. Let's talk about, because let's face it, the farmers I know who are retiring and are selling farms, they're getting up there. People farm for a long time. I think it's the fountain of youth. But anyway, they farm for a long time. And so if they do this and then a health concern arises, and all of a sudden the need for the capital that they have invested arises because they've got long-term health care needs and things like that, this money is locked up.
Huge downside to doing this is exactly that. Okay. So we have to make sure that we've planned properly, so we have the adequate funds to think about long-term care planning. It's critical to do that. So if that key person for you as a farmer is your accountant to help you think through that, that's great. This might be an investment or financial advisor type person might help you think through that as well. That would be critical if you want to bring them into the equation. But absolutely, again, all of that, I would definitely put that in a bucket where I'm thinking about what sort of liquid assets do I need for the next, let's say 10, 15, 20 years. Like, let's
Mm-hmm.
plan this thing completely out and make sure that I have availability of that cash to do what might need to happen.
Okay. Now, at the beginning of the show, you talked about, and I don't know if you meant to phrase it this way, but you talked about wanting to pass it down. If you do have a farm that you want to pass down, either to a family member or maybe somebody who has been working on your farm and they want to get their start, that type of thing, and you want to do some sort of farm transition, is there a way to incorporate this 1031 exchange into that?
Probably not. So if you're looking to keep the farm in the family, and to do it that way, which I think is a great option. No, I don't think there's a way to sort of incorporate that. If you're The only thing that I could theoretically see is if you were looking to potentially down any sort of sale you're looking to make with the property, this could play. So let's say, for example, maybe you're looking to downsize, right?
Mm-hmm.
From some bigger, some larger to a smaller. You can't do that in a 1031 exchange. You'll have what's referred to as what they're called boot in that transaction, or excess, right? If you go from only 5 million to 2 million in farmland, there's excess there. There's a play there for the Delaware statutory trust product to take that boot down. And we'll see that more often with real estate investors, where they just can't find a $5 million property, but they found a 3 million one they really like.
Mm-hmm.
Well, what are we going to do with that extra 2 million? I don't want to pay tax on that. So then there's a play there. But if you're not looking to sell, if you have a plan to pass this along, probably not a play.
Okay. Okay. Interesting. Now, you're referring to the investors as owners when it comes to these real estate investments. So, help me understand how they are shielded from liability if they're considered an owner.
Mhm. Great question. Inside of the agreement for Delaware statutory trust, you're purchasing a portion of that trust. The trust is then separated from the investment, right? So
Okay.
then the trust becomes liable. The loan is to the trust on the investment, right? And it separates and shields the ability for them to look at that beyond. So then the sponsor sits in that transaction. You should see the tangled web we weave when we look at this from a diagram perspective.
Mm-hmm.
The sponsor and the trust stand in there as liable entities. Investors do not. Investors aren't even seen through that process, right? You can't even see them there. So it's all about the trust, the investment, the trust, the property, and the sponsor or operator are the people that are liable for this on this transaction, not you as an investor.
Okay.
It's some smart lawyer figured this stuff out, my friend, to figure out how to structure these things and um, make them fly and work with the IRS and Treasury, and to still reduce our liability as well.
Mm-hmm.
It's kind of an impressive thing.
Okay. Now, people are going to get hung up on the name of this, a Delaware Trust. Why is it called Delaware?
I don't know. I mean, this is we got to work with the marketing arm of this space and call it a different name, because every time I bring this up at every conference that I speak at, heads start to spin and roll. So yes, we need help. We need a marketing arm for this space to call it something different. I guess fractional ownership share doesn't roll off the tongue either. So
Mm-hmm.
work in progress. So I don't know where the origins of this came from, frankly, from a naming convention, but we got to do better to make this a little bit more appealing.
Okay. When a potential client comes to you and you're talking about this, this sponsor here or this, this group you can invest with over there, how do you suggest they go about investigating and investigating the risk, investigating the credibility of that particular investment group to where they get comfortable with, I'm not getting caught up in something here that's not above board?
Yep. Great question. So what is nice and sort of challenging about this at the same time is every one of these investments have about a 400 to 600 page offering document with amendments on the back of them. So it makes for great late night reading, but it's boring as can be. What's great is buried inside of those agreements is the sponsor's history on every single deal that they've done. So what we've done to help out a little bit is to call all that out, and to show that to you in a format that is easier to digest. So you can see immediately where things went right for every sponsor. And frankly, our largest sponsors, a lot of this has gone right, but there are some deals that haven't gone right.
Mm-hmm.
So the details of those are in there as well. So you can start to understand, what did go wrong here. and why did it go wrong? And we can evaluate with you to help you think about, yes, that makes sense, or no, it doesn't. That was poorly ran, and I don't like this sponsor. Or conversely, if there's a lot of newcomers to this space, and they pop up every time real estate gets very expensive and people want to sell, there might not be a sponsor history. That's a huge risk factor. We tend to steer away from those. But if there is still interest in that deal and that sponsor, we'll conduct an interview with our clients of that sponsor and sort of get to the bottom of who they are and what sort of experience they have.
Okay.
So working through the document is number one, but we want to help with that a little bit. Needless to say, even I don't think it's fun to dig through 600-page documents, but all that information is there, which is great.
Okay. Well, Brandon, what have I not asked you that people need to know?
These are phenomenal questions. So I think we covered a lot of the pieces. I really want listeners to walk out of this and farmers to really walk out of this and say, oh, I have other options that I may not have thought of before. That's the biggest takeaway I want them to have from listening to this conversation, is that there are other choices that you can make instead of waiting. So again, I really think these choices become very personal and they drift and steer away from economics. Once we've covered economics and said, okay, economically this makes sense, every decision I've seen with every client we've worked with becomes extremely personal about what they want to invest in, how much they want to invest in, and what they want to do with their life. That's really what we're talking about. So it's critical for them to have sort of that thought process. And I just encourage folks, if they're thinking about this, just reach out to us here. And I'm willing to have, I really want to have the conversation with you to figure out if this makes sense for you or not. Okay.
Well, where can people go for more information if they'd like to speak with you further?
A couple of different places. Insight1031.com is our website. That's a place to start. Or you can shoot me a message, Brandon@insight1031.com. And I'd love to speak with you.
Awesome. Well, Brandon, thank you so much for coming on and sharing this with us today.
No, thanks, Matt. Awesome questions. And I hope your listeners find some value here and learn something they didn't know.
Well, thank you for being here, everybody. Thank you to Brandon Bruckman for coming on the Off-Farm Income Podcast Day and sharing that information. And hey, I hope it helps somebody out there in the audience. As always, enjoy your journey to the ultimate lifestyle business, agriculture.